Alright, Nick Fenton here with TickerTank.com, founder. Moving on to part 6 of our naked put entry criteria video series. In part 5 we discussed return on capital. Part 6 we are going to be discussing the minimum acceptable theoretical probability of success. So our minimum acceptable return on capital, as we noted, was 0.75% daily return on capital. The minimum acceptable theoretical probability of success, and when I say probability of success, I mean probability of break even or better, is 75%. So they're both 0.75 and 75. How can you analyze to see if the probability of success is 75% or higher? It's pretty simple. We took a look at this FSLR trade in part 5, and we determined that 37 times 0.75, which is our minimum acceptable daily return on capital, 0.75, is 27.75. So we wanted to look at the strike that is closest to that 27.75 number, but not below it. In this case, 30 is below it, so we don't want to use 30. 31 is closest, but not below it. So we're at 30.65 return on capital, roughly 0.8% daily return on capital if you were to hold until expiration. So let's click on the bid, and once you click on the bid here, right click in this orange pinkish area and you hit analyze duplicate trade. I already had this loaded up, so let me get rid of that. The first thing you want to do is make sure your probability date up here at the top right is in line with your expiration month. So we have May expiration, so we want May 18th as our probability date. That's the Saturday, so the expiration Friday is the 17th. I always choose the Saturday because that's when everything's settled and you get the most accurate reflection of what this particular strategy will do by expiration. Next thing you want to do is go your set slices and make sure your break even is set to that 5.1813 in this particular example. So that puts our break even at 30.70. Let me pull this down, make the screen a bit bigger so we've got a nice big risk plot profile chart here, move some things around. So you can see, assuming a 93-cent fill, we have a max gain, of course, of $93 per contract, which means that you keep the entire spread. That max gain is achieved at 31 or higher. Once FSLR, if it starts moving below 31, then you start to see a little bit of decay in profit potential until it hits that break even of 30.07. Below 30.07 is when you start to see losses, and those losses are, capped out at FSLR going all the way to 0 by May expiration, which is a very improbable situation. But we want to focus on the probabilities of success here. We mentioned our minimum acceptable theoretical probability of break-even or better is 75%. In this case, you can see it's 78.47 theoretical probability of break-even or better, 21.67 of break-even or worse. So this does meet our criteria of 75% minimum acceptable. It's 3.5% roughly higher than the minimum acceptable level, and it meets the ROC, minimum acceptable daily ROC criteria, and it's liquid enough. If we go back to this trade screen, you can see the liquidity here. On the 31 strike, we've got 3-cent bid-ask spread. If we look at the closest to the money 36 strike, we've got enough volume. It exceeds that 500. It's not quite 1,000 open interest, but it's close enough. I mean, we're talking about 75 off, 85 off. So I mean, that's close enough. It's liquid enough to trade. And if you look in this particular strike's volume and open interest, not quite as attractive as the closest to the money strike is, but again, there's some activity here, so you shouldn't have any problems getting filled, and the liquidity is good enough. The only thing that we are missing here is our time preference criteria, which is 50 to 65 days preferred on entry. We've only got 37 days left here, so we're not quite far enough out. So I personally pass on this particular trade, but for the sake of using it as an example, it's a very good example of what could be a great opportunity in naked put entry. It does meet the ROC criteria, it does meet the liquidity criteria, and it does meet the minimum acceptable theoretical probability of break-even or better criteria over here on the Analyze tab, being 78%, a little over 78%. So that's how you utilize the probability, or that's how I utilize the probability parameters here. And it's just, it's another good piece of the puzzle. Put it all together, and you're going to get yourself in some really good situations in the future. Right now it's pretty difficult with the VIX being as low as it is. Let's pull up the chart of the VIX. So we currently have the VIX at 12.52, which of course is not an optimal situation for premium sellers. But when we get the VIX back towards this 18 and above range, you're really going to see a lot of opportunities. You're going to be able to take these tools that I've taught in this video series and utilize them and make some really good naked put trades. In part 7, we're going to discuss how to scan for these trades to quickly find potential candidates in any volatility environment. So I'll see you there in part 7.